I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace, and today I'm joined by Brad Thomas, longtime Seeking Alpha author focused on the real estate sector who runs the Seeking Alpha Marketplace service, iREIT on Alpha. He's got a background in the real estate industry predating his time writing and investing in the market, and so I'm excited to have him on. Brad, good morning.
It's great to see you, and I'm glad to see you're doing well.
Yeah, the same for you. It's crazy times. I wanted to jump into the real estate sector. It's April 2nd as we record this. April 1st was a reminder that we're still in a bear market. We're not out of the bad stuff. And then today we just got jobless claims. So there's still a lot going on. We want to talk about how that impacts the real estate sector as a whole. But real estate is really a number of subsectors, right? I mean, you have different parts of the REIT industry, the real estate investment trust industry. So how are you looking at it from a sector level in your part of the market?
Well, first off, these are unprecedented times, as we all know. I've lived through a couple recessions, and it's because of the last recession that I'm now involved with your organization, Seeking Alpha, and I appreciate that opportunity. But this is a totally different, paradigm than I've ever seen, and most all of us have seen. It's a once in a lifetime, situation, and we're all living through this and learning every day. But one of the benefits for investing in REITs in the U.S. is there is such a diversified number of property sectors. So you can practically invest in any different asset class, and they all have different ways they're managing this risk that we now see. Now I'll refer to it as a black swan. Some may argue that it was not predictable, but I believe it was predictable, but I believe this was fully unpredictable. And we're now seeing that in the marketplace, obviously, on a daily basis. So it's very volatile. And we're basically, every day screening for companies that we feel like offer the best risk-adjusted returns. We've made some changes with a lot of our recommendations. In fact, we've completely pivoted our strategy to 100% defense. We've always been pretty defensive. And obviously I didn't coin the word swan or sleep well at night. Somebody else did. We use that a lot. But there are a number of companies now that certainly don't fit that swan status given these unprecedented times. So, it's definitely a new paradigm, but I think there's great opportunity that exists in really mining for gold, as I call it, and being able to buy some of the highest quality real estate in the world at incredible discounts. So I'm sure we'll talk about that here on this video.
Yeah, I'm curious to hear a little bit more what separates the high quality companies. I know I've invested in real estate companies in the past, and I know, balance sheets tend to be pretty levered, for example, and that's something that's top of mind for most investors, I think, in this period is how's your balance sheet. So what are you looking for as far as sorting out somebody to be in the stronger category? What are the characteristics you tend to find that are giving you those sleep well at night sort of stocks in that time where it's not easy to sleep well?
Sure. First of all, I just counted this morning. There are 19 mortgage and equity REITs thus far that we found that have cut or suspended dividends. Right. I would say half of those are related to mortgage, or some of those are mortgage, and I would say half of those are lodging. And then you have other sectors in net lease. Global net lease just cut. You've got shopping centers already cutting, Whitestone. And fortunately, we predicted even before this black swan that many of these companies were going to cut their dividends. So in a way, we were very much prepared for this event, Daniel, because we have been really looking at balance sheets very closely. I mean, we knew that a recession was looming at some point. So we had certainly, like most of the REITs, equity REITs, as REIT analysts, we've prepared for this inevitable pullback in the form of a recession. So it's obviously a much severe shock to the real estate market than anybody had anticipated. But I will say that quality is always going to win the race, and so we've really really doubled down or really tripled down on selecting the highest quality companies. We created a new portfolio called the Cash is King portfolio, just purposely designed to put capital into REITs that were the highest quality names, trading at remarkable discounts, and really not cutting any edges, just making sure these companies were going to be holding up. And the biggest thing is we just want to make sure these companies don't cut their dividend. And so These REITs are being tested right now in a big way. And I think you're going to see more than 19 companies when this is over that are going to cut their dividend. In fact, I think certain sectors, we could see a transformational shift in retail and malls specifically. And we'll talk about that, I'm shortly.
Right. So when you're talking about that quality, you mentioned balance sheet, obviously, and cash is king, and it's just sort of being ready to hold up. Are you also looking at things like, let's say, lodging REITs, we're all factoring in that hotels are going to be closed for 6 months or 12 months or whatever the period is. For retail, consumer behavior might be changing as we all go to e-commerce. How much are you factoring that in? And also, how much is, I know in the wider market, Amazon is not trading any cheaper than it was before. Costco is still trading at 30 times earnings or something. Those sorts of names are not being discounted. So you are seeing, I guess I'm just curious a little bit more about the discounting you're seeing and the types of names and how you're kind of putting them in that bucket.
Sure. First of all, I mean, I think this is definitely a temporary event. The question is how temporary? Are we talking, we're definitely not talking weeks. I think everybody's of the opinion, and I've listened to a lot of opinions here over the last several weeks, but I think that the consensus is this is going to be much longer. Even the president stepped up recently and really did the right thing and was being more of a realist, I think, as a leader of this country. So I think being a realist, I think it's important to look at this is a temporary event, but it's going to take a while. So what are those temporary, disruptions that are going to impact, shares in these companies? And we've been looking really close at this CARES Act. Obviously, this is kind of I call it a Band-Aid. It's the stimulus money. And frankly, it really provides something along the lines of business interruption insurance is probably the best way to look at it for companies. It's not like the lottery ticket where, these companies are going to get, they're going to be profitable, overnight because of the stimulus money. It's just a Band-Aid that's going to keep them operational until we move away from what I call physical distancing, into a more normal work environment and consumer environment. And so, but a couple things that I'll say to this point is we looked at the CARES Act, and while it does provide advantages for certain sectors like lodging, for example, and gaming, it also includes restaurants, and which is really interesting because it includes restaurants, but it does not include retail. And so what I mean by that, there are small businesses that can benefit from the stimulus money that are under 500 employees. But those companies that are larger retailers, for example, like let's take all of the names that you see walking through a Simon Mall or a Washington Prime Mall or Macerich Mall, Gucci, Nike, the big brands, and they have over 500 employees. Well, guess what? They don't have stimulus coming to them. And also the double whammy to that business model, I'm talking malls now, is that these companies are going to, they're supposed to pay rent. We had a really interesting situation occur last week, and I reported on this at Forbes, where Cheesecake Factory decided to stop paying rent. The CEO basically came out and said, we're not paying rent for April. And so that triggered, in my opinion, a series of messaging from a lot of these mall REITs, particularly Tallman, I think, was the first to make it public and send a memo out to all of his tenants saying that you have to pay rent. Now, you got to think of it like this. If you're a big company and you don't have access to those companies, you don't have access to those malls, these customers can't go in, you can't operate the property. You got to think, you're along the lines of the Cheesecake Factory CEO, I'm not paying rent. Now, Cheesecake is a really different situation, and I'm quite surprised by the CEO's actions because of the fact that they do operate in malls, but they have exterior entries, so they can still operate their businesses. So I'm a little confused with those initiatives with Cheesecake, but I think you're going to see, the bottom line is you're going to see rent checks that are not going to get cut. And the question is, when those rent checks aren't cut, does that mean the dividends are going to get cut? And so, we've become extremely more defensive to this sector, the retail sector in general. I just wrote yesterday on this retail apocalypse. I think there are 400 comments, and I appreciate everybody's comments. I'm sorry I couldn't get back to some of those. But I will say, there's definitely an ongoing question is the survival of this whole mall model. Now, I've been saying this for a long time, Daniel, Seeking Alpha. You can go to my articles dating back, even last year, I think, when I wrote about the supply and demand of the mall space. And I've always said this, there are way too many malls in the U.S. Our records indicate there are 1,400 malls. There should be half that number. And we felt like there was a period of normal, rationalization that was going to occur over the next 10 to 20 years in which malls would go away and be repurposed to other mixed use or even industrial or other uses. I think now with this coronavirus, especially if this goes on to extended innings, which it seems like it is, you're going to see a number of malls going away quicker. And it's going to take, much shorter than 10 or 20 years. It's going to take, a couple of months. A lot of these mom and pop tenants, even though they may have access to this, these funds. And by the way, I talked to a number of bankers and customers and actually CEOs, and this money is not, it's taking a lot of time. A lot of people don't still understand it. The banks have to really understand what they're doing because they're processing these loans for the SBA. Mm-hmm. So I think, we're in April 2nd, as you pointed out. So these rent checks need to be cut, and these companies don't have the money to pay the rent, and they're waiting to go through the process of getting the funds. And again, this is just a Band-Aid. A lot of these companies, Daniel, weren't profitable to start with. As a former franchisee for Papa John's, I used to always say, you're a snowstorm away from going out of business. Well, now it's not a snowstorm. I mean, there's a lot of franchisees and small businesses who are just operating month to month. And so I think this is going to really disrupt retail and malls in general. And that's why we're more bearish. Simon is one of the few names that we do have a buy rating on now. The company does have adequate liquidity. It's the golden rule. He who has the gold makes the rules. Simon has a lot of gold, and they certainly have a lot of landlord power in the mall sector. And I think at the end of the day, this is temporary. And when this is over, I think Simon's going to be much stronger because, frankly, their competition is getting much, much, much weaker. So I question whether a year from now, when you and I are talking, whether or not we'll have 7 publicly traded mall REITs. I think we'll have far fewer than that. And I think that's how my view of this mall sector today. Tanger is obviously not a mall, but they have they're an outlet center. And I think the outlet business model will survive. It's not going to go the way of the dinosaur. Outlets didn't have the same supply and demand problem that malls have. But I will say it's going to impact these tenants. These tenants are going to be impacted. And again, these companies, these larger retailers, they're too large to participate in the CARE Act funds. So they're going to have to do it on their own. And if they can't get to the malls, if the customers can't get to the outlets, then they're not paying rent. So we think there's a very good chance that company, even Tanger, again, that's why we've pivoted to this more defensive strategy and really more defensive recommendation. Is I think there's going to be some shorter term pain, but again, there's long term gains, and that's really the essential thing that investors should remember. I mean, this is really a beaten down sector, and we're treading very lightly in that category. Now there are some sectors that I think we believe have higher risk adjusted returns. Net lease is another sector with obviously longer term leases. Now they also have the same issues, and to a certain extent that the malls and the shopping centers do, because they have certain tenants that are going to be impacted. And I'm going to point out a name that many of you are familiar with, Store Capital. We've covered Store since the company went public. That's ticker STOR. Warren Buffett, or I should say Berkshire Hathaway, has an investment in Store Capital. And I like Store's business model. They do a great job, probably one of the best jobs at underwriting their individual assets, and they really focus on unit level economics, which means they have some of the most profitable net lease real estate likely in the country. They're not investment grade oriented like, say, Realty Income, that focuses more on the investment grade credits behind their operators. But Stores had they sold off, I don't know the close yesterday, but I think they hit almost an all-time low. I mean, they sold off drastically. A lot of Stores customers are these middle market companies that can get the CARES Act funding, but again, they need it quickly, I'm sure. And that's obviously having an impact to the share price because that's a big part of their revenue. They're not investment grade companies. But I will say, there's not one single REIT, Daniel, that is pandemic proof. Good example of that is Realty Income, another net lease REIT. And they do have a large majority of investment grade tenants, and they're very selective, and they have a great underwriting program just like STORE. But again, you're looking at Realty Income's portfolio, and I wrote about this today. They do have exposure to the theater space, roughly 7%. And they do have exposure to LA Fitness, roughly 3%. Just those two categories alone represent 10% of the overall revenue of Realty Income. Now, that Realty Income does have a satisfactory payout ratio of around 82%. So even if those rent checks didn't show up, say in April and May for Realty Income, for the theaters and the LA Fitness, the company still has adequate capacity to cover its dividend. And I think they will do everything in their power to continue with their mantra of the monthly dividend company, which means they increase dividends every single year, and they have since they went public. But certainly you can see this is a wide-reaching situation that most every property sector is seeing across the board. And I think looking at the CARES Act is really essential in the impact and the timing of that. Now, I will want to point out, we did also upgrade Omega Healthcare recently to a strong buy. We've always been fairly bullish with Omega, even through the difficult times where there were some operator issues in 2018, 2019. We did move the company away from its swan status, which means they didn't have the same blue chip credentials, frankly, because the payout ratio to Omega was getting tighter and tighter as operators were having more problems. Now, again, looking at the CARES Act, I think we see that the skilled nursing operators are going to benefit. They are included as Medicare, Medicaid participants, that these operators will have access to these funds, which they should. I think everybody agrees this is a healthcare crisis before it was a financial crisis, and healthcare is really the root of this issue. So I think the companies like Omega's operators will have, in our model, around $1 million of Band-Aid, or what I call business insurance, we'll call it for lack of a better word, to continue operating through this cycle. Because these are critical mission assets. When this finally goes away, and again, this is a temporary event, we all must understand, but when this goes away, we're still going to need this demand of skilled nursing facilities. The question I have is, will we need the demand of these malls? And I've always argued we had too many. So I think this is going to really change the landscape of retail.
Do you see any other sectors that are going to have, there's sort of the temporary effects, as you mentioned. There's also the fact that those temporary effects could be a knock-on because tenants fail or because the large companies stop paying rent or whatever else. And I think you laid that out well. Are there any other sort of consumer habit level long-term effects you could see? For example, one that's popular that I think I brought up when we did a written roundtable last week was the work from home and the pressure it puts on office REITs. I'm just curious if you see any other, whether you buy that thesis or you see any other longer term sort of changes that you're watching for as, amidst these unprecedented times.
Sure. Well, we've covered the office sector in great detail. And, I just saw an article yesterday that WeWork is already starting to negotiate, which they should, with their landlords, many of which are office REITs. Mm-hmm. And, so you're already seeing that impact. And I think you're right. I think there's this behavioral element where you're seeing various habits that are formed. And the longer this goes, I think the longer these old habits change, and there are going to be new habits. And I've already seen that personally myself in my going to the gym, which I don't go to the gym anymore. I walk in the Target parking lot, and now I can't go to the gym because they're closed. And so I think habits are going to continue to change. And in the office sector, you're right. I mean, I think we're starting to see a huge demand in Zoom. We're actually doing videos now for our members at iREIT on Alpha, as well as Dividend Kings. And we're using video platform to communicate, just like you and I are, to customers. And it's been a really valuable part of our service. I think people really are adapting to this new age. And so you're right. There are certain sectors that are going to, certainly lose to this, but we think there are also sectors like cell towers and data centers that are certainly going to be benefactors to this extended period that we're in. So I think that's where we look at. Another sector that I think is interesting is the campus housing sector. There's only one publicly traded campus housing REIT, but it really hits home. I've got a son who graduates from high school in May, and I've got a daughter who graduates from college in May. And it's in fact, my oldest daughter, she is getting a refund because her campus housing, her dormitory, she paid for through the end of the year. Perhaps I did too, but she's getting a refund for that. And so we've been looking at American campus pretty closely, and they've gotten really beaten down, and they've got a great balance sheet, plenty of liquidity, but you gotta understand the impact to companies like American Campus Housing. Now, again, I think this is a very temporary event. I don't think that people are they're gonna stop going to college as a result of this coronavirus. The big question is this gonna go through August? And if it goes through August, we're talking about back to school and how that impacts retail. And look at all these retailers that are gonna suffer because they don't have back to school sales. And so, like I said, the longer this goes on, I think you're gonna see, much more dire consequences. Again, we've got 19 REITs that have cut the dividend. We're watching these very closely. And by the way, just because a company cuts a dividend doesn't mean it's a bad stock. I mean, I see this a lot on Seeking Alpha, and there's a lot of people. I mean, we certainly want to avoid dividend cuts, but we think at the end of the day, this is all going to be temporary. And I really think for REIT investors, this is, I guess, my takeaway message. This is the opportunity of a lifetime. I'm personally looking to build my net worth substantially over the next couple of months. I'm working 7 days a week, and I really believe that there's some tremendous opportunities. I got excited when I was development. I'd go out and build shopping centers or net lease buildings, and the value that I would create, with building buildings. But this is like no other. There's tremendous opportunity to unlock value. I can buy institutionally held real estate at amazing prices right now. So we think there's a great opportunity, but you've got to be tactical and strategic and know what you're investing in. And again, we're trying to look at this retail sector with a really a different lens, because we think there's going to be a record number of store closures, and potentially the impact to the consumer, I think, is going to be pretty tough. I mean, you just pointed out there's 6.6 million people that are having jobless claims. And by the way, that number was predicted to be 3 to 5 million. So I think the potentially a wave of personal bankruptcies that are also going to impact, obviously, consumer sentiment and behaviors in this country. So, again, it's disruptive, but I think there's certainly opportunity in the chaos.
Okay. Any last thoughts or any last names that you're looking at as potential opportunities? Yeah,
there's a lot. Again, in terms of retail, I mean, we're being very careful. I mean, that is the higher risk. So we've gone through and looked at each of these sectors. Some of the lower risk sectors, I talked about the data centers. Digital realty, we just wrote on it, is really fairly valued at this point. We're waiting on a pullback because they've actually performed fairly well. But CyrusOne is still rather cheap right now. Obviously, they've got a new CEO. There's a little shift there. But we think there's a lot of value with CyrusOne. Potentially, that company could go private. There's that rumor been floating around for quite some time. And I wouldn't be surprised to see Blackstone go to work here. I mean, if I were Blackstone, I'd be circling around a couple names right now. Obviously, CyrusOne's been reported on quite frequently. Cell towers, I mean, obviously, it's hard to get into cell towers right now because the prices are still somewhat elevated. We're watching. Self-storage is a pretty resilient space. People are still going to store their stuff. There's not any physical interaction there really to speak of. Public storage is a really attractive buy for us right now. Fortress balance sheet. We just wrote on that today on Seeking Alpha about this. There's 7 public companies have A-rated balance sheets. We like all those companies for various reasons, and they all have various risk reward thesis that go with them. So single family residential is another sector I like. Multifamily is a good sector. There's a lot of different places. And, prisons, I will point out, I mean, prisons are really speculative. We've always said they're speculative. Obviously, there's prisoners that are, also getting sick. So you've got to remember that. It's every sector is being touched by this. But, the prison model itself, I mean, it's a critical mission asset. It's going to be around in 6 months and 6 years. It obviously has the political tie to it, and certainly more speculative in terms of the leverage and the debt that these prison operators have. So and at this point in the game, Daniel, I know we've recommended some of those more speculative companies in the past, but my question is, why do you want to buy some of these higher risk companies when you can get, great buys right now with some, great companies with great balance sheets? So we've really pulled back away from some of this high yielding REITs right now because there's so much value that we see in the higher quality names out there. So, I've really pivoted to defense, and I believe at the end of the day, like I said, this is temporary. It's gonna come back, and I think everybody's going to be appreciative of the fact that they've bought some really incredible property in the form of REITs during this crisis.
Okay, all right. Let's leave it there. Any disclosures in any of the names you mentioned? I mean, I know I
should have written down the list. So obviously, Realty Income is my largest holding. I did talk about that. I still own Store, and I own Cyrus One on Digital Realty in the data center base, cell towers that we own Crown Castle. I own Public Storage and Extra Space. Office, we do own Easterly. I didn't talk about it, but DEA. Net Lease, again, I talked about that. WP Carey, we own WP Carey still. Healthcare, we do own Ventas, Physicians Realty, Omega Healthcare, LTC. And I do own both of the prison REITs in a speculative position, which means modest position in CoreCivic and Geo. Gaming, we still have Vici. Still own Simon, and we still own Tanger. I'm riding it out. And I think Tanger eventually will come back in some form or fashion. Outlets aren't going away. And I think that's about it.
Okay. It's thorough enough. I should say that I have a position in Berkshire, which came up very briefly. So, okay, Brad, thank you so much. Stay safe out there, both health-wise and investing-wise, and thank you for coming on.
Great. Thank you.